Hey everyone, Assalamu alaikum. Welcome back to T Accounts. So in this video, we'll be solving A-level May-June 2024 paper 11, which is of 1 hour, and we have 30 MCQs in it. So let's begin. The first question says, Jamie is setting up a business. There are three details which are important to Jamie, right? So let's read the question first. It says, which type of business should Jamie choose? So while reading the details, we have to make sure that all the three are met, and then Jamie decides the business that he wants to choose. The first one is Jimmy wants to have a salary for his work in managing the business. Then he also wants full ownership of the business, and he also wants to avoid the risk of losing personal assets. Right? So point number 3. This means that Jamie doesn't want unlimited liability. He wants to have limited liability so that he doesn't lose his personal assets. And that can't be done if he decides to become a sole trader or form a partnership. So then these two options are eliminated from the choice, that he can't become a sole trader or partnership, as they both offer unlimited liability. So option A and B can't be right. This means that he has to move towards forming a company. And if we talk about point number 2, that Jamie wants to have full ownership of the business, now this can't be done if he decides to form a public limited company, because in public limited company the owner has to issue shares to the general public. This means that Jamie can't be the sole owner, the sole shareholder of the public limited company if he decides to form that. This means that he can only opt for the private limited company option, because in that only you can be the sole shareholder of the business, and you can have the full ownership of the business, which can't be done in a public limited company. Similarly, in point number 1, Jamie, if he wants to have a salary for his own work, so he can do that if he forms the private limited company as well. So that's why option C is correct. Question number 2 says, the owner of a business paid for business stationery using her personal assets, using her personal funds. So this means that the owner did not use the asset resource of bank or cash held by the business. Rather, she used her personal funds to pay off a business expense. The question is, which ledger account will be credited? So what will be the double entry if this is done? Stationery, being a business expense, will be debited when it is paid. Stationery will be debited, but what will be credited? Should I credit bank or cash? No, I can't do that, because that belongs to the business, and business asset or cash, business asset, bank and cash hasn't been involved in this transaction, right? So what is involved is the owner's capital account. The investment by the owner in the business will increase by making a payment for a business expense, because she used her own personal funds. So this means that she did not decrease the bank or cash, right? This did not happen. So if that hasn't been happening, and an expense is being paid at the same time but using the owner's personal funds, that will increase the capital, because there is no decrease in the asset resource of the business. So option A will be correct, that capital will be credited in such transaction. Question number 3 is, why does a business charge depreciation? The reason for charging depreciation, we have 3 points. Number 1 is to be able to replace an asset at the end of its useful life. No, this is not the reason why we charge depreciation. Asset can be replaced or it can't be replaced at the end of its useful life, but depreciation has to be charged in accordance with prudence and matching. Why? Because of point number 2, it says that to charge the cost of an asset to each period that benefits from its use. Yes, to divide the cost of the asset over its estimated useful life, and charging an expense against the use of that asset every year is why we charge depreciation. So this is right. Point number 3 is to treat each asset according to the concept of consistency. Right? So consistency says that the method of depreciation, whatever the method you adopt for that particular asset, should be applied consistently throughout its useful life. However, that method can be changed, provided that the change in method offers a more true and fair value of the asset, right? So if you decide to choose the method, it shouldn't be to manipulate profits or to show a more better picture of your assets in front of your investors. No, that shouldn't be done. But if the method results in providing a realistic value of the non-current asset reflecting a better depreciation of that asset, then that can be done, right? So point 3 can't be right, that you always stick to the same method. It can be changed provided the reason shouldn't be to manipulate the profits. So option 1 was also wrong, only 2 is correct, that is B. Question number 4. The following information relates to the non-current assets of a business that was formed 3 years ago. Okay. In calculating the draft profit for year 3, depreciation has been consistently charged using the straight line method. So in this table, we have information that cost at the start of year 1 is this, accumulated depreciation at the end of year 3. So this depreciation represents 3 years of depreciation, and we know that by reading the first statement that they are using the straight line method. So if 6,000 is the accumulated depreciation of 3 years, this means that per year they would have charged 2,000, right? That is how it became 6,000 for 3 years. Further, it says prior to finalizing the accounts, the business decided to change the method. Okay, decided to change the method of depreciation for year 3 only to reducing balance method at a rate of 25% per annum. Okay. What was the revised profit for year 3? The draft profit was already given to us, in which we have depreciated the asset at straight line method, and which was of 2,000. However, in year 3 only they want to change the method and move towards reducing balance method. So in reducing balance method, we already know that we charge depreciation on the net book value of the non-current asset. So we have to find out what would be the depreciation in year 3 and how that would impact the profit in year 3. So for that, I want the net book value at the start of year 3, so that I can apply the depreciation rate on that net book value. So what is the cost? The cost will remain same, that is 10,000. Accumulated depreciation, that should be subtracted from this cost, so that we arrive at the net book value at the start of year 3 would only be 4,000. Why? Because 2,000 is not being charged as we are moving towards the reducing balance method. So this depreciation won't be counted as it was calculated using the straight line method, and in year 3 I want to shift towards reducing balance, so only 4,000 of accumulated depreciation will be subtracted from the cost. This will give me a net book value of 6,000, and on this I will apply the reducing balance method of 25%. Yeah, so 6,000 into 25% would be 1,500 of depreciation charge. Under straight line method, we charge 2,000. Under reducing balance, we'll be charging only 1,500, so 500 less. So we want the revised profit for year 3, as it was calculated at 18,000, which included depreciation of 2,000. So we can add back the 2,000 depreciation charged under straight line method, and we can subtract the 1,500 charged under reducing balance method. You can do this, or you can just add the net figure, which is 500 between the two. So that would be 18,500, option C. Moving on, question number 5. Why does a business maintain a sales ledger control account? Okay. Option 1. To ensure that statements are sent out promptly to customers. Statement means statements of account. This should be done irrespective SLCA is being maintained or not, as it is a step towards reminding your customers so that they settle their dues on time, and they are also aware the transactions that took place between the two businesses during the month. So this is not why we prepare SLCA. Second is to record the total of discounts received. No, total is recorded in the cash book whenever a transaction happens, then that is transferred to the discount received account. Moreover, discount received is maintained for purchases ledger, not for sales ledger control account. So this is again wrong. Third is to reduce the risk of irrecoverable debts. No, we adopt other policies to reduce the chances of irrecoverable debts, such as we stop supplying on credit to some doubtful customers. We offer cash discounts on prompt payments to encourage customers to settle their dues on time, etc., etc. But again, that is not why we prepare SLCA. The main reason for preparing SLCA is to check the arithmetical accuracy of the sales ledger as we match the entries made in the sales ledger with the ones that are recorded in the day books, and any discrepancy is then found and corrected. So option D will be correct. Question number 6. Ega is worried that her bookkeeper may have been forgetting to record the credit notes received. Credit notes received. Credit notes received means returns inwards or returns outwards. This is returns outwards. That is also called purchases returns. When I am returning goods to my supplier, I issue debit notes and the supplier sends credit notes. So in this case, I am receiving credit notes means I am issuing debit notes, and whenever there are purchases returns or returns outwards, the business issues. So Ega is issuing debit notes, and in response she is receiving credit notes from the supplier. So for supplier that is returns inwards, for Ega this is returns outwards. What should she do to find out that whether the bookkeeper is forgetting to record the credit notes received or returns outwards or not? 3 points. Let's read from point number 3. Prepare a purchases ledger control account. Okay, so if she decides to prepare a PLCA, how would she compare that whether this credit notes received were recorded or not? There has to be something to compare with, right? So that can't be done. Similarly, point number 2, extract a trial balance showing individual purchases ledger balances. Again, that would just show the balances calculated in the purchases ledger in the T accounts of the suppliers, and again she won't be able to identify whether the credit notes received were recorded or not because there is no comparative available. Point number 1 is check purchases ledger balances against statements of account. Yes, if she is comparing the two resources, so she can identify whether credit notes received were recorded in the statements of account or not. So she can find out whether some are recorded or some are missed. So only point number 1 is correct, not 2 and 3, because there in these two she doesn't have anything to compare her purchases ledger balances with. 7. A trial balance does not balance and a suspense account is opened. On investigation, the following errors are found. Let's read the question first. What is the opening balance on the suspense account? Okay, so let's prepare a T account, and we have to find out whether there is a balance brought down on the debit side or whether there is a balance brought down on the credit side. That would be the balancing figure in this question. Number 1, the debit balance. Okay, the debit balance of 450 on the carriage outwards account. Carriage outwards account is an expense account and it will have a debit balance, has been brought down as 540. Okay, so while bringing down the balance as BD in carriage outwards account on the debit side, instead of 450 we overstated the balance by 540. So there is an overstatement on the debit side of an expense account, and if I want to reduce it, if I want it to come to 450, I have to credit it with the difference between the two figures. So what would be the double entry? Carriage outwards needs to be credited with 90 so that it comes back to 450, and suspense should be debited with the same value in order to complete the double entry. So this correction will result in entry in the suspense account, and that on the debit side against carriage outwards. So first is corrected. Second is the purchase returns journal has been overcast by $100. So if the journal is overcast, this means that the T account would also be overcast. Purchases returns journal, purchases returns has a credit nature, and this means that it is overstated on the credit side by 100. So if I want it to come to its original value, that is to reduce it by 100, I have to now debit it by $100. So purchases returns will be debited by 100 and suspense account will be credited by 100 to complete the double entry. So this will be corrected on the credit side against purchases returns. So far we are done with 2 corrections. Number 3, a check for 50 received from Alan Green. So this means that the transaction should be recorded as bank debit and Alan Green credit. But what happened is has been posted to the credit account of Brian Green. So instead of crediting Alan Green, we have credited Brian Green. So what should I do? First of all, credit Alan Green, because that is what should have been done, by 50, and debit Brian Green, because this shouldn't have been done, and in order to eliminate the balance from the credit side of Brian Green's account, I have to now debit it by 50, not 500. So this is how this error will be corrected, but since this is an error of commission, it won't affect the suspense account, and this error would result the trial balance balancing, as it is not revealed by the trial balance. It's an error of commission, so there will be no entry in the suspense account because of this error. Question number 4. Rent received of 350, rent received is an income, has been posted to the debit of rent paid account. Rent paid account has been incorrectly debited. So first of all, let's credit rent paid, that is rent expense account, will be credited by 350 in order to eliminate the wrong entry. And what else should I do? That rent received of 350, right? Don't debit rent received. Rent received is an income. Incomes are always credited whenever they are received. So rent received will also be credited in order to record this income. And what should I debit? Now suspense will be debited to complete the double entry by the total 700. So suspense will be debited twice, once by 350 as rent expense, and again by rent income, it is rent received, 350 again. That's it. Now we have to find out whether, as we can see that there is a shortage on the credit side, so the balance brought down, the opening balance in the suspense account would be 90 plus 350 plus 350 minus 100, that is 690 credit. So the option is A. Question number 8, related to bank reconciliation statement. Says the table shows extracts from a business's bank reconciliation. Okay, the question is, what is the bank balance to be shown in the financial statements? The bank balance that should go in the financial statements is always the updated cash book balance, right? And that can be found in two ways. Either we can prepare an updated cash book, that is, we adjust the unadjusted cash book balance with the adjustments such as standing order, direct debits, bank charges, etc. Or we can prepare a bank reconciliation statement. We start the statement with bank balance as per bank statement. We adjust the unpresented and uncredited deposits so that we arrive at the balance as per updated cash book. So there are two ways in which this question can be done. Let's do the first one first. We have balance as per cash book at 31st December. So this is the unadjusted balance, because we have to find out the corrected one. 2075 debit. Okay, so cash book, I'm making the updated cash book, so BD is 2075, it's a debit balance. Then balance as per bank statement at 31st December, this is our balance as per bank statement, ignore this for the time being. Then we have bank charges per bank statement, not entered in the cash book, of course. So bank charges will be adjusted in the cash book by making an entry on the credit side. Bank charges and outstanding checks not presented by the year end, these are present in the cash book but not in the bank statement, so they will be adjusted in the bank reconciliation statement, right? So these two will be used to prepare the bank reconciliation statement. We'll have a look at that also. Now only this adjustment will be required to update the updated cash book, and that will result in a balance of 1925, right? This is my balance as per updated cash book that should go in the statement of financial position, option number B. There's another way to solve this question, that is, if we prepare a bank reconciliation statement and we start with the balance as per bank statement, that is 2250 credit means a debit balance, because from the perspective of bank we are a liability, so liabilities have credit balance, which is a normal balance, and it represents a positive balance. It is just written as credit because from their perspective we are a liability to them. So 2250, and the only adjustment that is required in the bank reconciliation statement is of presented checks, that is outstanding checks not presented for payment, and they are subtracted if we start the bank reconciliation statement with balance as per bank statement. So again we will arrive at the same value 1925, which is the balance as per updated cash book. So you can do either way to find your answer. Number 9. The total of trade payables balances in Conrad's purchases ledger was 57,400. So purchases ledger, a ledger that shows all the suppliers' T accounts, and when he totaled that ledger, it was 57,400. The following errors were then discovered. The question is, what is the correct total of trade payables balances? So we know that we have to start with 57,400, which is the brought down for the purchases ledger. Now let's see which adjustments will be required to correct the trade payables balances. The first is discount allowed overcast in cash book. Discount allowed is an expense related to your debtors. It doesn't have anything to do with the purchases ledger. Discount received and is recorded in purchases ledger, right? Not discount allowed. Moreover, the problem is just in cash book, so it would have been corrected in the control account and not in the ledger, but again sales ledger. So this won't be used to correct the purchases ledger balances, as it doesn't belong to your suppliers. Second is returns outwards omitted in a supplier's account. The problem is in the supplier's account and we are correcting the supplier's account balances. So if this has been omitted, we have to adjust the 350. Now returns outwards reduce your liability, right? You don't have to pay for the goods that you have returned. So from 57,400 I should subtract 350, as I won't be paying for these goods. They reduce my liability. They are recorded on the debit side of the supplier's account. That is why. Number 3 is payments to trade payables undercast in cash book. So while recording the payments in cash book, we have made a mistake. We under-recorded that payment by 137. But do you think that this error should also be corrected in the purchases ledger? No, it won't be. Why? Because again the problem is in the day book of original entry. In the day book, the error hasn't been carried forward in the purchases ledger. So there is no problem in the purchases ledger. This error won't be corrected. Similarly, purchases journal has been overcast. While totaling the purchases journal, we totaled it incorrectly, and the wrong total was transferred to the purchases journal, right? Does that also mean that the wrong total was transferred to the purchases ledger account as well? No. In purchases ledger, we transfer individual transactions, so the totaling error wouldn't affect the purchases ledger. So only one adjustment was required to correct the purchases ledger balances, and that would result in a corrected balance of 57050. Option D. Question number 10. Which statement is not correct? Right, so there will be only one incorrect answer and 3 will be correct. Let's start from option D. A sales ledger control account includes irrecoverable debts. Of course it does. On the credit side, we record irrecoverable debts because the entry to record irrecoverable debts is irrecoverable debts debit being an expense, and your debtor account is credited, so SLC is also credited, right? C is debit balances in purchases ledger are current assets. So we know that the two control accounts can have unusual balances. In case of SLCA, an SLCA can have credit balances. This means that the business has to pay to the debtor, and in case of PLCA, it can have debit balances, means the supplier will pay to the business. So over here it says debit balances in a purchases ledger are current assets. This is true? Yes, this is true if there is an unusual balance, a debit balance in PLCA. This represents that the supplier has to pay to the business bank. For instance, if we paid the supplier first and then we returned some goods, so for that amount, to settle that amount, the supplier will pay back the business, right? Or if there was an overpayment by our business to the supplier, so that will again be settled by the supplier making a payment back to the business. Suppliers can pay back to the business, and in that case that will be a receivable for the business, and receivable is a current asset. So this is also correct. B is credit balances in a sales ledger control account are trade receivables. No. Credit balances, again an unusual balance, means the debtor has to pay back, the business has to pay back to the debtor. Now if we are paying our debtor, that is a payable for the business, and payables are not trade receivables, they are trade payables. An unusual balance in SLCA represents a payment by the business to the debtor. So this is wrong. This is incorrect. Option A is also correct. Why? Because it says control accounts reveal whether there are errors in the sales and purchases ledger. Yes, by comparison, we do find out some errors that have happened between the two. 3 are right, only 1 is wrong. Question number 11. A business maintains an allowance for irrecoverable debts of 5% of trade receivables. The percentage is fixed. At the end of the current financial year, the trade receivables totaled 8,000, which was 20% less than the year before. Okay, let's stop here. So current trade receivables are 8,000. How much will be the previous trade receivables? The question says they are 20%. These are 20% less than the last year, in the year before. Can we find out the trade receivables in the last year? Yes, we can. How? If 8,000 represents 80% of last year's trade receivables, how much would be the last year's trade receivable? They would be standing at 100%, because this year 20% are less. So previous trade receivables, the last year's trade receivables would be 10,000, and a reduction of 20% in the current year is 8,000. Further it says, how will the profit for the current financial year be affected by the change in the allowance for irrecoverable debts? The percentage is fixed as it is not changing in the question. So we just have to find out whether there was an increase or decrease in the allowance for irrecoverable debts, and how did that affect the profit. For that we have to find out the change in allowance for irrecoverable debts between the 2 years. So in the current year, it would be applied at 8,000. The rate of 5%, that would be 400. It is in the current year, and last year it was on 10,000 into 5%. It was 500 last year. Last year we estimated that $500 of debts might become irrecoverable. This year we are just estimating 400. So there is a decrease in allowance for irrecoverable debts of how much? Of $100. That will be recorded as an income in my statement of profit or loss, and that would, if that is being recorded as an income, that would increase or decrease my profit. Of course, it will increase my profit by 100, as this year I am estimating $100 less allowance for irrecoverable debts. So the effect on profit has been asked. That is an increase in profit by 100. Question number 12. A trader does not keep full records but supplies the following information. Okay, the question. Let's read the question first. What was the total amount of sales during the year? In the table we have bank balance and cash balance, opening and closing both. So this means that we might have to prepare T accounts for the two. Let's prepare this first. Bank account and a cash account, right? And let's input the values as well. Bank debit balance 4240, brought down is 4240, and on 31st December 6320, carried down. Similarly for cash, brought down is 264 and carried down is 271. Now let's read the transactions. What happened? Checks issued during the year were 19,950. Checks issued means payments from the bank. So bank should have been credited. And let's do that. For payments, we issued checks amounting to 19950. Then what else happened? All takings from sales were banked, except that cash of 5,400 was used for drawings and 7,200 was paid for wages. So the way the sales are being recorded is as they are first recorded in the cash account, sales credit, cash debit, and then from that cash account the takings from the sales are banked. But we did not bank all the sales recorded in cash account. Rather, we used some of the cash sales amount to pay for drawings to pay for wages. So only these values 5400 and 7200 wages were not banked because they were already used while they were there in the cash account to pay for wages and to extract drawings. So let's record from the cash account. On the credit side, that cash was credited because it was used for drawings amounting to 5400, and 7200 was paid from the cash account for wages, and the money came from the cash takings. So these two were not banked. Then in addition, 3000 was paid to bank for the sale of motor vehicle. Okay, so let's record that also. If we are receiving something from the sale of a non-current asset, that is called disposal proceeds. The disposal proceeds account is credited and bank will be debited as it is showing an income. So 3000 disposal proceeds. Now we have to find out how much were the sales, the total sales. So what would have happened? We would have recorded all the sales in the cash account first, and then we would have banked a value in the bank account. So now there would be two transactions that we have to locate. First one would be that how much we have received in the bank account, and that will be on the debit side. And secondly, how much we would have received in the first place from our sales as cash sales, and that would be our answer. So let's first balance the bank account so that we find out how much we received from the cash account, how much was transferred from the cash account. So bank 4240 on the debit side plus 3000. This is a lower figure. The debit side is lighter right now because there is an amount missing. So 19950 plus 6320 minus these two would be 19030, which was received from cash, right? So the reason why we adjusted all the transactions in the bank account and in the cash account was to find out how much was received from the cash account as cash sales banked. If we wouldn't have done this, we couldn't arrive at the correct figure. This has to be done in order to find out the missing figure, and it should always be 1 in 1T account. So this means that the double entry for this would have been bank, debit and cash credit. This is a type of a contra entry. So from cash account, I have to eliminate this value as this was transferred to the bank account. Now I can find out the actual value of my sales which I recorded in my cash account. So that would be, add these four, 5400 plus 7200 plus the amount banked and the CD balance minus the opening balance. So that would be 31637 sales. These were the total sales. We paid these two out of these cash sales and the remaining was transferred to the bank account. So your answer is C. Question number 13. Which statements are true of drawings? First one is, they are a reduction in the owner's investment. Drawings is also called a contra capital account because it reduces your capital balance. As you extract something out of the business, so of course that reduces your capital account balance. So yes, it does show a reduction in capital investment, in owner's investment. And if we can also recall the equation that closing capital is equals to opening capital plus profit or minus loss minus drawings plus additional investment. So yes, drawings are subtracted as it shows a decrease in capital. So this is correct. Number 2 is, they have to be less than the profit for the year. No, there is no such restriction that it can be less than the profit for the year. It can be more. Ideally, it should be less. the owner should be taking less out of the business so that the investment remains in the business, but there is no such restriction, so this can't be right. Third is they represent the salary paid to the owner. No, salary, if the owner wants a salary, it can be incorporated in some other way, but drawings represent a reduction in capital. That is why they are called a contra capital account. They are not an expense for the business. No, they are not recorded in the operating expenses or in the statement of profit or loss as drawings by the owner being an expense. No, they are recorded in the statement of financial position, right? So that is why only one is correct, which is B. Question number 14. Vikram is a partner in a business. Partners do not receive salaries or interest on capital, but they are charged 5% interest on balance of their drawings account. Okay, so no salaries, no interest on capital. However, there is interest on drawings at the rate of 5%. Right. Vikram made drawings of 40,000 during the year, and his share of profits was 47,500. His current account showed, let's read the question first. What was the debit balance on Vikram's current account at the beginning of the financial year? So we have to find out the balance brought down, and we are told in the question that it will be a debit balance. Current accounts usually have credit balances as they are a type of a capital account, but in this case Vikram has opening debit balance in his current account, and we have to find that out. Right, we are given with some figures, and that we have to put in this T account to find out the balance brought down. For that, we should be aware of the current account format. That balance brought down could either fall on debit or credit side. Same goes for CD. Drawings and interest on drawings comes on the debit side, and any incomes for the partner, for instance share of profit, interest on capital or salaries, that comes on the credit side. And if there is a loss, share of loss, that also comes on the debit side. Right, so right now we don't have any salaries, we don't have any interest on capital. Interest on drawings is 5%, so on the debit side we will first enter drawings and interest on drawings as well. So drawings are 40,000, Vikram's drawings are 40,000, and interest on that would be 40,000 into 5 is 2,000 interest on drawings. Then we are also told that his share of profit was 47,500, so profit share is 47,500. that comes on the credit side as it shows an increase in income. And we are also told that his current account showed a credit balance of 4,500 after the relevant entries were made at the end of the financial year. So this is credit balance at the end of the year. This is balance carried down given to us. Right, it says credit balance, but this means that its brought down will fall on the credit side. Right, after totaling the T account, the current account, the BD will be on the credit side amounting to 4,500. So this means that the CD is on the debit side. Right, carried downs are given from the perspective of where the brought down will fall. So brought down will be on the credit side. This means that carried down is on the debit side. So we have there's no other figure remaining, so the balancing figure will now be the balance brought down, and that would be 40,000 plus 2,000 plus 4,500 minus 47,500, and that would be 1,000 brought down on the debit side. Moving on, question number 15. A partnership operates without having a partnership agreement. Right, so if there is no partnership agreement made by the partners, which act is followed? Partnership Act 1890 is followed, and it has various provisions, which is, for instance, profits and losses are shared equally. There is no salary, no interest on capital, no interest on drawings, and if the partner has given loan to the partnership business, the interest on that would be 5%, not more, not less. So let's find out that which rules will apply to the partnership in the absence of partnership agreement. Partners will be entitled to interest on any loans made by the business at a rate of 10%. No, it is 5% fixed, not more, not less. This is wrong. Partners will be entitled to interest on their capital at a rate of 5%. No, there is no interest on capital. Thirdly, partners will not be charged interest on their drawings. Yes, this is correct. In the absence of partnership agreement under Partnership Act 1890, there is no interest on drawings. And last, partners will not be entitled to a salary. This is also correct. So only 3 and 4 are correct. Option D. 16. L and M are in partnership, sharing profits and losses in the ratio 3:2. The following information was available. We have their capital account balances, and we are also told that interest on capital is 8%. We have the drawings taken by them during the year, and interest on drawings is 5%. Then partners' salaries are also there for both the partners. Also, we are told that the residual profit shared by L's share of profit is 24,000. And the question is, what was the profit for the year before appropriations? Which profit is being asked? The profit before distributing it as salaries and interest on capital and before all the appropriations, right? So if we can just recall the format of appropriation account for partnership, it starts with the profit for the year. In this question, we are asked to calculate this. This means that we have to work backwards. We have to less interest on drawings, we have to add interest on capital, we have to add salary to the partners, and of course the residual profits as well will be added back, right? So keeping this format in mind, let's begin. We have to find out the profit for the year. Profit for the year is unknown. Let's suppose it's X, right? Then first of all, interest on capital will be subtracted from the profit for the year. Interest on capital, I'm just writing the way how it is made in the format. We will work backwards and then we will see what is added and what is being subtracted. So interest on capital to L and M, what is the capital? 200,000 into 8% is 16,000, and 150,000 into 8% is 12,000. So this is 28,000. Interest on capital is given to the partner, so it will be subtracted from the profit for the year. Then interest on drawings, they are added to the profit for the year for both the partners L and M. 5% on 30,000 and 5% on 20,000. So 30,000 into 5% is 1,500, and to 20,000 into 5% is 1,000. Total 2,500 will be added to the profit for the year. And then we have salaries as well to the partners L and M. 22,000 and 17,000. Total is 39,000. That will also be subtracted from the profit for the year, right? Now after doing all of this, we will be having residual profit, but right now we can't calculate that as we don't know the profit for the year. Let's suppose it is Y, and then this Y will be distributed amongst L and M, and L's share we are already told that is 24,000, right? So if I know this thing, if I know this figure, can't I find this out? I can, of course. How? I know that L's share is 3 out of 5, right? 3:2 is the share between L and M. So if 3:5 is the share of L, and that would have been multiplied by the residual profit in this case, which is Y, so his share would be 24,000, right? That's how we do it. The residual profit is divided amongst the partners using the profit and loss sharing ratio. So L's would be 3/5 into residual profit, and his share is 24,000. So this means that the residual profit would be 24,000 multiplied by 5 divided by 3. That would be 40,000. The residual profit after doing all the appropriations is 40,000. But this is not what we were supposed to find out, right? This is not the answer. We have to find out profit for the year, which is X. So how do we do that? Now we have to work backwards. 40,000, this was subtracted, now it will be added, plus 39,000 minus 2,500, that is interest on drawings, and plus 28,000 will give me profit for the year, which will be 104,500. That is option C. Question number 17 says, which statements about debenture interest are correct? Debentures are loan certificates issued by companies. Only companies can issue that, and they are treated just like a non-current liability. So interest, the return on debentures is called interest. So what is true about debentures? Let's find out. Number 1, interest percentage rate will always be higher than the dividends per share. No, it won't always be higher. It can be higher, it can be lower as well. That is why shareholders can receive very high dividends in cases of high profits, in cases of if the directors decide and if the directors and shareholders decide that they want to give more dividends to the shareholders, so they can receive very high amount of dividends. So this can't be right. Debenture interest rate is always fixed, but ordinary shareholders receive varying returns, so that can be high and that can also be low. So this is not right. Second is interest will be deducted in the statement of changes in equity. No. Statement of changes in equity shows the distribution of equity or what changes, increase or decrease took place during the year, but in equity only, in share or share capital and in reserves. Debenture is not an equity. It is not a reserve. It is a non-current liability, and its interest is subtracted in the statement of profit or loss, not in the statement of changes in equity. So this is also wrong. Third is interest will be paid before ordinary shareholders dividends. Yes, this is correct because it is paid in statement of profit or loss, and after that we prepare statement of changes in equity. So this is correct. And interest will be paid even if the company records a loss. This is also correct. As being a liability, we have to charge interest on that. We have to pay interest on that liability in any case. So this is also right. That is option D, 3 and 4. Question number 18. A company has the following reserves. It has share premium, revaluation, general reserve, and retained earnings. The directors wish to make a bonus issue of ordinary shares of $1 each. $1 each would be the par value. Bonus issues are always at par value. The question is, what is the maximum number of bonus shares which the company could possibly issue? Right, the maximum. Now in this question we are not told that the policy is like 1 new ordinary share for every 3 already held. It's not like that. We are being asked that how maximum can we issue. So for bonus issue we know that we utilize the reserves to issue bonus shares. We don't raise any cash from bonus issue, but we utilize the reserves. And the priority in which the bonus shares could be distributed is from the number 1 is from share premium. We can use all of the share premium to issue bonus shares. Then second priority is general reserves, and lastly retained earnings. We don't use revaluation reserve to finance bonus issue. So we can't use this. We can only use share premium, general reserve, and retained earnings. All of that can be used to finance the bonus shares, right? So 60,000 plus 10,000 plus 21,500. All of the reserves can be used to finance the bonus issue, and that would be 91,500. Right? That is option B. That all of it can be used. Question number 19. A business provided the following information for a period. Let's read the question first. What was the value of inventory at the beginning of the period? Right. So what are we asked? We have to find out the opening inventory. And in question we have sales revenue, we have purchases, and we have inventory at the end. That is, we have closing inventory. And what else are we told? We are told that rate of inventory turnover for the period was 12 times. What is the formula to calculate rate of inventory turnover? Rate of inventory turnover is cost of sales upon average inventory. And what is average inventory? Average inventory is, let's write that down over here. Average inventory is opening inventory plus closing inventory divided by 2. And what else are we told? That business attained a gross margin of 40%. Okay, so gross margin is 40%. Right? Gross margin is on sales, and under this, if I write the equation, profit is sales minus cost. So if the profit is 40% and on margin, sales are kept 100 and cost is the difference between sales and profit, so it would be 60. The business also made some purchases returns and incurred an amount for carriage inwards. Okay. Question is, we have to find out the opening inventory. So how do we go about this question? If I need opening inventory, right, and that can only be found using the average inventory formula, because it comes in average inventory. And for average inventory, I first have to find out the average inventory, and that comes in the rate of inventory turnover formula. In this formula, we are told the rate of inventory turnover, which is 12 times, but we don't have the cost of sales. So first, let's find out cost of sales using margin. Number 1, margin. We want this. So this, let's keep this unknown. Upon what do we already have? We have sales revenue amounting to 1500,000, that is 100 into 1500,000. This will give me cost of sales of 900,000. Yes, I found one thing. Let's put this in this formula. That rate of inventory turnover is 12 times, so it's 12. Cost of sales, I've just found out, 900,000 upon average inventory, that is unknown. So 900,000 divided by 12 would be average inventory of 75,000. This is the second thing which we have found out. Now let's put the average inventory in this formula to calculate opening inventory. Average inventory is 75,000. Opening inventory is required, plus closing inventory was already given, 50,000. So 50,000 divided by 2. So opening inventory would be 75,000 into 2 minus 50,000. That would be opening inventory of 100,000. A. Although we were given that there are some purchases returns and there was some carriage inwards as well, but there is no information, further information, that through which we can find this out, and that is already incorporated in the calculation of cost of sales, so we don't have to find that out separately. We can use the cost of sales calculated using margin and put that in average inventory formula to calculate opening inventory. Question number 20, very interesting question. It says, when comparing with the previous year, a trader finds that his gross profit margin has increased. Let's stop here. Gross profit margin has increased. What is the formula for gross profit margin? It is gross profit upon sales. Now when can this increase? When either my sales increase, and that too in selling price, right? My selling price, if that is increased, my GP margin will increase, or my cost of sales decreases, right? That is why my profit would also increase if my cost of sales decreases. And secondly, we are also told that his trade receivables turnover has decreased. So has trade receivables turnover, what's the formula for trade receivables turnover? That is trade receivables upon credit sales into 365. So when can that decrease? If, for instance, my trade receivables decrease, if the numerator decreases, the overall answer decreases as well. Or if my denominator, that is my sales, increase. So if the denominator increases, the overall ratio also decreases. So now in both the cases, we can see that the sales are increasing. That could lead to the two ratios behaving the way they are behaving. Now the question is, which statement would explain this? Let's begin. First is, he bought in bulk and passed the savings on to his customers who bought more. Right. So if the customers are buying more and if you are also buying more, so that just leads to an increase in sales volume, not in selling price, and GP margin is affected by the increase or decrease in selling price. So this won't be correct. Secondly, he offered more trade discount and more customers paid in cash. Okay, so this could be the reason that trade receivables are decreasing as they are paying in cash, but then again, this won't be any reason to show an increase in GP margin, because neither cost of sales is decreasing because of this, and neither the sales price is increasing because of that. So this can't be right again. C is he raised his selling price, yes, okay, and offered more cash discounts. Okay, so this means that if he's raising his selling price, the GP margin would increase, and if he is offering more cash discounts, so this could also mean that trade receivables would be paying early. They want to take the discount offer. This is the reason why the GP margin is increasing and the trade receivables turnover is decreasing, that they are paying early to avail the discount. So this is correct. Option D says, he reduced his selling price to increase the total value of sales. The total volume would rise, but that won't result in an increase in GP margin. So again, this can't be right. We want both the ratios to be behaving accordingly because of his change in strategy. So that's it. Question number 21 is, B Limited had credit sales of for the year 3285000 and trade receivables at the year end of 405,000. The sales director believed that if cash discounts had been given, then trade receivables would have been 351,000 and the allowance for irrecoverable debts would have been reduced by 9,000. Okay, so what's the question? Question is, what difference would the discounts have made to the trade receivables turnover? Again, we have to compare the two. So let's find out the current trade receivables turnover. How do we find that out? Trade receivables turnover is trade receivables upon credit sales. So right now the trade receivables are 405,000. Upon credit sales are 3,285,000. So 3,285,000 times 365. The answer is in days, and that would be 45 days. So currently customers pay us in 45 days, and if the strategy is adopted, that is of giving trade discounts, cash discounts, then he is expecting that the trade receivables would be 351,000. So the new trade receivables turnover would be, trade receivables would decrease as they will be paying early, and the total sales, since the question is silent, so that would remain the same, into 365. Okay, so we are also going with the allowance for irrecoverable debts. We know that we don't incorporate allowance for irrecoverable debts in the trade receivables turnover. We just take that trade receivables which we find through sales ledger control account, or yes, so sales ledger control account. In sales ledger control account, we don't incorporate allowance for irrecoverable debts, since that is just an estimation of how much debts could be turned into irrecoverable debts. So we don't use that. That is just given to confuse you. You can ignore that. So the new trade receivables turnover would be then 39 days if we offer the cash discounts. So as you can see that right now it's 45, and he is right that the customers would pay early, and by how many days they will be paying early? 45 minus 39, by 6 days. So that is, they will be paying 6 days faster. Option C. 22. Okay, so costing. A business makes wedding dresses. Each machinist is paid $30 a day and each supervisor $40 a day. Right, so two types of labor pays are given, machinist and supervisor. Then we are also told that each supervisor can work with up to 10 machinists. So each supervisor can supervise 10 machinists, and each machinist can produce one wedding dress a day. So one machinist will produce one wedding dress, 30 machinists will produce 30 wedding dresses, and each supervisor can supervise 10 machinists at that time. The question is, if 95 wedding dresses a day are produced, what is the daily labor cost? So we know that if we first calculate the machinist cost, that to produce 95 wedding dresses, and if one machinist can produce one wedding dress, so 95 machinists would be required, and each machinist is paid how much? $30. So into $30 would be the cost of the machinist. 95 into 30, that would be 2850. Now the supervisors. How many supervisors would be required to supervise 95 machinists? How many? One supervisor can supervise 10 machinists. So this means that for 95 machinists, and if each supervisor can supervise 10 machinists, so that would be 9.5. But 9.5 supervisors can't be hired, so we have to hire 10 supervisors to supervise the 95 machinists. Right? We have to pay for full, even if he is just supervising the 5 super machinists, so we have to still pay in full. So for 10 supervisors we will be paying $40, and that would be 400 to the supervisors. So the total cost would be 2850 plus 400, and that is 3250. Question number 23. Which statement best describes variable cost? So variable cost is a cost that varies with the changes in output. It remains same per unit, but it changes in total. If the total output is increased, it also increases. If total output is decreased, that is, it also decreases. So option 1 is costs that are same in total up to a certain level, then increase with output. No, this is not the definition of variable cost. Such cost can be shown on a graph like that. It is total up to a certain level, and then it increases with output. That is not a variable cost. A variable cost graph is like this. So this can be called a semi-variable cost. or semi-fixed cost. This is not right. Number 2 is costs that are same in total over any output level. So what is this? This is like this. Over any output level they are same. This is fixed cost. This is not variable cost. Third is costs that are constant per unit as output increases. Whatever the output is, it remains unchanged per unit. That is variable cost. Of course, in total it gets increased or decreased, but per unit it remains the same. So yes, this is correct. And D is cost that increases per unit as output increases. No, that is not right, because variable cost per unit remains constant. Question number 24. P Limited makes wooden chairs at a unit cost of 70 each. So each chair is made at a cost of $70. It has received an order to produce a batch of 1000 wooden chairs with padded seats. Okay. This requires 6000 additional materials, an extra 500 labor hours at 15 per hour, and a 2000 increase in overheads. Right? Because of the batch, because of the new order, it has to incur some extra cost. Now what is the cost of the batch? Now the basic cost would be of each chair, since it is $70 per unit, so for 1000 chairs it would be 70,000. Right, this will be incurred in any case, but since it is being produced with padded seats, so we are incurring some additional cost and we have to incorporate that too in the batch. So for additional materials, that would be 6,000, so it will also be added. Similarly, there is an extra labor hours being utilized to produce that chair, that type of chairs, so the labor cost would also increase, and that would be, since 500 hours will be more required, and that for every hour we will be paying $15, so in total we will be paying 7500 extra to our labor, and there is an increase in overheads as well. How much? 2000 increase. So the total cost would be 70 plus 6000 plus 7500 plus 2000, that would be 85,500. Question number 25. Why would overheads be overabsorbed? The reasons for overheads being overabsorbed. There are two reasons for overheads if they are overabsorbed. The first one is when actual overheads expense is less than the budgeted. So what you were expecting, what you absorbed, what you budgeted was more than what you actually incurred. So actual overheads are if they are less than the budgeted. And similarly, if the actual activity level is more than the estimated activity level, so there is again overabsorption of overheads. If the actual production or if the actual hours utilized to make the product are more than the estimated level of activity, so again there is overabsorption. So what are the two reasons? Let's write them down. If actual overheads are less than budgeted or absorbed overheads, and if actual production is more than the budgeted or absorbed production. Let's see where we can find any of the two options. First is overheads absorbed is less than the overheads budgeted. No, they both mean almost the same thing, so no, we have to compare the actuals with the budgeted or absorbed. Then second is again against absorbed and budgeted, so this is not right. Then C is overheads incurred. Incurred means the actual is less than the overheads absorbed. Yes, when overheads incurred actual are less than the overheads absorbed, so this is correct. This is when overabsorption happens. And D is overheads incurred is more than the absorbed. No, this is wrong. This is the opposite. This is the underabsorption. Question number 26. A company makes one product with a selling price of $384 per unit. The costs are as follows. The question is, first let's read the question. What is the factory OAR, overhead absorption rate per labor hour? OAR is calculated on fixed production overheads, and that we have to find out OAR. And we are given with the direct material that per unit we use 4 kilos at 8 per kilo, direct labor is 8 hours at 12 per hour, selling and distribution is $40, and the markup is 50%. So we are told about all the costs, be it production or non-production, but we just have to find out one cost, that is the fixed production overheads. Also we are told that the markup is 50%. So in markup we know that markup is on cost, so profit is sales minus cost, and the markup is 50, so cost will be 100 and sales will be 150. So can I find first the total cost using this formula? Yes, I can. If the unknown is cost and the known is selling price, and I multiply it with the selling price, I can come to know of the total cost. That would be per unit $256. This is my total cost. Now I know the total cost. I just have to incorporate these three and find out one cost that is unknown, which is fixed production overheads. So cost per unit is direct material 4 into 8 32, direct labor 8 into 12 96, fixed production overheads is unknown, and selling and distribution are also told 40, the total of which will be $256. So right now I just have to work backwards. 256 minus 40 minus 96 minus 32, the fixed production overheads would be $88. But we have to find that fixed overhead absorption rate per labor hour, so we will divide it by the number of hours, and that is, sorry, not 11, that is 8 hours. That would be $11 per labor hour. C. Question number 27. Which statements about marginal costing are correct? Okay, marginal costing, we know that it uses variable cost per unit, all the variable cost, to calculate the inventory, or in the calculation of product cost. Number 1 is, it enables the business to make the best use of its resources when there is a limiting factor. This is true, that we make a production, we find out the best possible production mix that gives us the most contribution using the limiting factors. That is done in marginal costing. This is correct. Second is, it ensures that decisions taken are based upon the total cost of producing a product. No, not total cost, only on variable cost under marginal costing. So this can't be right. Total cost of production is used in absorption costing. Third is, it takes into account apportionment of service cost to production cost center. Again, no, that is done in absorption costing, that it absorbs the service cost center's cost to the production cost center, and then an OAR is calculated, which is incorporated in the production cost of the product. 4 is, it usually leads to a lower inventory valuation than absorption costing. This is correct. Why? Because in inventory, while calculating inventory, we value the inventory only on variable cost. We don't incorporate the fixed cost. So therefore it offers a lower inventory value as compared to absorption costing, because it takes into account the fixed production overhead, that is the OAR. So 1 and 4 only, option A. Question number 28. Third last question. A company makes and sells a single type of product. The budgeted information for 6,000 units is as follows. We have variable manufacturing, we have variable selling expenses, and we also have fixed manufacturing overheads and fixed admin overheads. The question is, before the question we are also told that the unit selling price is $40. How many units must the company produce and sell to achieve a target profit of 45,000? Okay, so we use a simple formula to find out the number of units, and that is just an extension of the break-even formula, that in order to find out the units, we add the target profit with the fixed cost, and we divide it by the contribution per unit, that is selling price minus variable cost per unit. So the target profit is 45,000, and what are the fixed costs? The total fixed costs are 54,000 and 21,000. The total is 75,000. So all the total costs, fixed costs only. The fixed cost is this, the target profit plus fixed cost divided by the contribution per unit. We are told the selling price, which is 40, but we don't know the variable cost per unit. How do we find that out? By dividing the total variable cost with the number of units. So the total variable cost is 96,000. 90,000 plus 6,000, 96,000 divided by 6,000 units. That would be $16. So this is the variable cost per unit. So 40 minus 16 would be the CPU, and that would give us 5,000 units in order to achieve a target profit of 45,000, option D. 29. The diagram shows a break-even chart. What does line XY represent? XY. Where is XY? This is XY. This vertical line is XY. What does it represent? It represents the difference between this point, which is break even. Break even is when the total cost and the sales revenue lines intersect. So there is no profit or no loss at this point, and the portion below break even is the portion of loss, and above is portion of profit. But what does this XY line represents? It represents the difference between break even revenue and the budgeted sales revenue, budgeted or actual. The difference between break even revenue and the actual or budgeted sales revenue. What is this called? This is the margin of safety. It represents the margin of safety in revenue, that after what point will the company start incurring a profit, or below the break even it will be incurring a loss. So let's see which option is that. The break even point revenue, no, XY is this. This is XY. Difference between sales revenue and break even, this is not correct. The margin of safety in terms of revenue, yes, this is correct. The profit at break even point, no, there is no profit at break even point. And the total contribution at break even point, no, it doesn't represent that, because it shows the portion above the break even. So that is margin of safety. Last question. What is not an assumption in CVP analysis? Not an assumption means 3 will be the assumptions and 1 won't be the assumption. So the first is the unit fixed cost is constant. Let's read from D actually. The units produced are all sold. Yes, this is correct. This is an analysis. This is an assumption of marginal costing, that all units produced will be sold. Second is option C. The unit variable cost is constant. This is also correct. That unit variable cost, and B is also correct, that unit selling prices will remain constant. In total they will change, of course. But A is not correct, that is the unit fixed cost is constant. No, it varies. In total the fixed cost remains constant. Total fixed cost remains constant. Okay, I hope you liked the video, and that's it for this one. I'll see you in the next one.